Welcome to Technical Tuesdays. This is Fred Razak, Senior Trading Strategist here at CMTrading. And today we're going to be discussing market conditions. But before we do, make sure to like and subscribe so that you could get future content just like this. There are I'm still going to say it again, there are four market conditions at any given time. There's not more, there's not less. One of four. So let's put out the first one, which is probably the simplest one to really look at. And that is when the market is not trading. So what does that look like? Well, it doesn't look like anything you have here on the MT4 trading platform, which is our trading platform. And the assets that we populate there are all tradable. At any given time, they're tradable, okay? They have liquidity, they have volume, they have character, and it may not be on a daily basis, but on a general basis throughout the year, you could take a handful of different assets on the MT4 trading platform and trade it at any given day. So what does an untradable asset look like? Okay, so here in CMTrading, we populate all the major, really the big major assets. But in other markets, okay, in the United States, there's something called pink sheets, where it's companies that have not made it to the major board, okay? They are small companies, and basically they trade something like this. They have like one move, it stays dormant the entire day. That's what the graph actually looks like. It stays the same price because nobody's been buying, no one's been selling, and it looks just like a flat line. And then it has another move, either up or down, but it's irrelevant because there's no character, there's no volume, there's no participants. It's trading sideways the entire day. That is not a market condition that anyone could really trade. If you're looking to invest in a pink sheet stock, that's something else, but tradable, it's not. Okay, so we're not talking about this type of market condition. Okay, I needed to go over it because it's one of the four. The other market condition, which happens most of the time, is what we call range-bound or sideways trading. That's where we're hitting two levels, either a bottom level and a top level, a resistance and a support, and we're bouncing off of it throughout most of the time. This happens between 80 to 90% of the time of any tradable asset, and it's fine. That is a market condition. As long as you've identified that market condition, you could set objectives to it, because if you're just trading haphazardly and you're not having any sort of objective as to what you can possibly take out of the market, then guess what? You're not going to do that. You're going to just not be able to identify what kind of market condition, and then you won't be able to identify what kind of objectives you can expect from that type of market condition. So the second one is when we're sideways trading. There could be subsets of support and resistance in this wider range, okay? And you could look at it as a longer or shorter time frame depending on what you're looking to trade. For example, right now gold is in an uptrend, short term, okay? When I mean short term, I'm talking about 3 weeks, 5-week trade, but I'm talking about long term, we're still in a range. We're trading between somewhere about below 2,000 and somewhere above 1,800. We're between those two levels, okay? So we're ostensibly on a longer time frame, we are actually looking as a range-bound trade, okay? But on a short term, we're just really just trending upwards, which leads me to the next market condition, which is upwards trends. Now, upwards trends are very biased because most people coming into the markets like to buy something, hold, and sell it at a higher price. And that is something that you can actually bank on, meaning to say when you're looking for something to break out, when you see that there's a trend developing, it goes up, it retraces, goes up higher, retraces higher, goes up higher, retraces higher. That's the point here. It's continuously money's being flowed. It's not going literally straight up like this, and it's not going sideways, but it is going up and down, but it's going, in generally speaking, it's going in an upwards momentum. And that's called an uptrend. And those type of market conditions, you could then set expectations based on that. For example, the example that I just gave about gold rallied to 1940 from 1800, which was a nice little $140 move. It's been slowly but surely getting to a point. But if I look at a longer time frame, I see that we're reaching resistance of a previous range, and so I'm going to unload here. Okay, this is my exit point in terms of, listen, I gave it my expectations and it ran through. Okay, now if you have a longer time frame of 5 to 10 years that you're looking to invest in gold, that's a different story. You could hold on to it and just, continuously hold on and, anticipation that it's going to go even higher. The last one, which is a downwards trend, where the markets sell off. Now, a good example of this is where Facebook has been over the past year and a half. And Facebook has really sold off in from its $300 range to about $89 a share. And it's continuously just kept on making new lows, and then finally capitulating at this $89. Now, they are reassessing their business plan. They're changing their business into metaverse. They're putting a lot of money into AI. And guess what happened? Market conditions changed. Now it's in an upwards trend. It's going from $90 to $145, okay? So it's in an upwards trend. But if I look at the longer time frame, okay, it's in a downwards trend, even though it bounced between $50 to $60. That's still the case that it's in a downwards trend. So it's two things. It's realizing market conditions and the time frames that you're looking at. But in order to maximize your profits, you have to identify what kind of market you're in. Thank you.